Well, good morning and welcome to the Solaris webinar. My name is Mark Cormack and I'm a director with Pinnacle Investment. Pinnacle works alongside Solaris to distribute their investment management capabilities to the Australian financial advisory marketplace. And today we're going to be joined by Solaris's Chief Investment Officer, Sean Martin, who's going to outline how the Solaris fund management team has been negotiating the market after the 1-2 punch that coronavirus has delivered, but more importantly, discuss the positioning and outlook of the portfolios going forward. Just in terms of background, Solaris, an Australian equity fund management boutique who've delivered outperformance over the ASX 200 in 16 out of 19 years. The core of the investment team has been together since the early 2000s, so they're experienced hands in managing portfolios in both up and down markets. The team, through their experience, has a great ability to cut through the noise, assess the facts, and translate them into solid, consistent investment returns for their investors. Excuse me. Solaris team adopt a style-neutral approach to investing in Australian equities, meaning they're not going to be held hostage to a growth or value style. And like all the boutiques within the Pinnacle Investment suite, the Solaris team own the majority of equity within their fund management business. Before we start today's session, just a reminder that all attendees have the opportunity to ask questions via the internet. This can be done by clicking the questions tab on your screen. So without further ado, I'll hand you over to Solaris's Chief Investment Officer, Sean Martin, to take you through today's presentation. Thanks, Sean.
Thanks, Mark. And it's fantastic to be here with you again and get the opportunity to talk through what are really historic times. Certainly in my career, it started in the mid-90s. It's been remarkable, doesn't do justice to what we've seen this calendar year. When I was speaking to you last, this is the second installment of our series on how the crisis is playing out. When I was speaking to you last in the third week of March, we were in raw panic. We were faced with Armageddon. How low was it to go? And indeed, what sort of a train wreck were we witnessing? A month's a long time in politics, they say. 2 months a ridiculously long time in this market, because the turnaround that we've seen has been just as ferocious. The market sell-off that we saw, that I quoted to you, of 35% down in a month, couldn't be described as anything as I say there on the screen. It's truly brutal. Truly ferocious would be the response. And ferocious is the word. It's been a rally that has been mocked more than I can remember, with market participants just not quite believing that the inverse of the raw panic we were witnessing when we last spoke has occurred with the same speed and brutal, ferocious, almost overnight attack on where we were. So challenging is a synonym here to opportunity. And I'll go through how we are attacking the bear market rally, if you like, if it is that, the bounce. But to summarise, we're attacking it the same way. And I think success in this market is simply not to believe that one needs to lose their fundamental approach. You don't need to reinvent the wheel just because of this unprecedented volatility. In fact, the success we have had has been just the opposite. By applying the very things that have given us the 20-year record that Mark was so kind to refer to, are even more applicable here, and putting positions on in businesses whose revenue isn't even here at the moment, and we'll go through examples, but like Star City, like Flight Centre, like Webjet, it doesn't really seem logical to do that. It certainly is very uncomfortable when you buy a business that is shut, but they have been some of our most lucrative investments in this crisis, because over and over, this crisis has seen stock markets price things quite irrationally, quite illogically, forcing one to exploit rather than use the stock market as a measuring stick. And we continue to have that approach. And that's exactly what I said 2 months ago. We're just talking now about a rally that looks a little bit unrealistic to many, not necessarily to us, but to many, in the same way that the sell-off and the degree of the sell-off looked unrealistic to us, but not particularly unrealistic to many. So I suppose we find ourselves again in the position of doing the opposite, turning off the noise, applying our process, and without being influenced by the deafening irrationality around us, applying our process and buying quality stocks that have been oversold and that have good balance sheets, while shorting and selling stocks that have poor balance sheets and poor competitive advantage. And that simple approach worked very, very well. So we'll run through a lot of things. The next slide, I think, I've made a blue here by not referring to the clown there, you can see. I asked the fellow who helps me with this slide pack that a clown might appropriately summarize how we're feeling about this. It does seem surreal. I didn't realize he'd get such a spooky clown. Oh, I don't know, I have nightmares about that thing, and I suddenly regret putting that face on this presentation. But anyway, the clown is the clown, and it feels like a bit of a market that suits that guy. The less said about that, the better. So if we move on, this is possibly a complex chart, but I really like it. It shows an average of all MSCI recoveries out of bear markets, which, as you know, are definable at 20% down or more since 1970, and it's aggregated them all across the light blue, from 1 year before the performance to the middle, which is the equity bear market end, i.e. when the bear market bottomed, and then how it went for the 1 year after. And what you can see here is a stunning demonstration of just how volatile, brutal, concentrated, whatever your word is, this crisis has been. We have done in a couple of months what usually takes a couple of years. This is by far the sharpest sell-off in the history since 1970 of bear markets, by far. You can see the steepness of what's that, orange line, which is current, compared to the light blue, which is the average. So the dark blue is the average, the light blue represents the 10th and 90th percentiles of the bear market since 1970. So it is by far the sharpest sell-off in the history of bear market since 1970, and equally, and I suppose appropriately, by far the steepest recovery in history. And that gives a little bit of context to the speed, ferocity, and indeed, therefore, stressfulness, if you like, of this market. And when I say stressfulness, stress often can marry with excitement. You know, they're quite close to each other in terms of emotion. And I find this market intoxicatingly exciting. But at the same time, that doesn't mean it's not stressful. So it taxes one's resources, and the amount of volatility that we are witnessing is off the chart, as this slide shows. I don't have a particular predictive conclusion out of this, and it's completely unapologetic. Has the market run too hard? I don't know. What's the shape of the recovery? I have no idea. V shape, U shape, L shape, W shape. I mean, I even heard someone having a VW shape the other day. I don't know what that is, but it is, again, I think I said last time that trying to logarithmically plot COVID curves country by country was a complete waste of my time and our time. Picking the appropriate letter that maps the recovery's path is equally a complete waste of time. And to be honest, as we talked previously, the timing of a recovery is not the most important thing to get right. The question that we're always asked is, when will it recover, or / has it recovered too quickly? I don't think they're the most important questions. The most important questions are, what is the market pricing at any point of time, and comparing that to what is reasonable. And we went through at length a few stocks that we thought had been priced too negatively last time. Well, as you'll see in a little while, that ferocious uptick, the most steep uptick in the history of bear markets, has indeed taken with it a few stocks in our portfolio that have now, in our eyes, run too far. So again, has the market run too hard? Well, I don't know. Have some stocks run too hard? We always find it much easier to pick stocks rather than stock markets. And indeed, yes, quite a few of the stocks that we liked 2 months ago have run too hard. And we'll talk to that in a little while. I really like that slide. I think it gives a great perspective as to just how ferocious the speed of both sell-off and recovery has been versus time. That is, it has won the speed race by the length of the straight. And so as a minimum, participants have a right to feel pretty fatigued. And what we are doing here at Solaris is to ensure that fundamentals are followed and what looks right is right. We don't have to worry too much about, that won't work in a corona crisis environment. If that was said in our collective meetings, I'd be really upset, because what worked in the GFC in terms of techniques will work in the COVID crisis, and will work in the crises that we don't know about still to come. Fundamentals will always win. Quality companies sold after indiscriminately being pushed down below their fair value with good balance sheets are always attractive to bring into our portfolio. So if we continue on with that question, having just said I have no idea, I'll then poke a bit of fun at some of the bears, which is always enjoyable, given they're always so moralistically superior, aren't they, bears? They seem to have this, arsenal in their back pocket that they know something that you don't. You're being naively confident when, in fact, this disaster is just around the corner. I can't tell you how many times I've heard that this is a rubbish rally in the last 2 months, and that it's unsustainable, and it's dumb money, and it's it just doesn't make sense and doesn't marry with the economic disaster coming forth, and every possible shameless talking of one's book that has occurred in the last 2 months. I mean, why don't you just admit you're short and this isn't helping? So that to me would be a little bit more honest. But there is that perception when you're selling fear that with a bearish stance that you have this knowledge that is about to end capitalism as we know it. And from the very beginning of this rally, we have heard all of these arguments. Is this smart? Is this rally smart or dumb money? It's just a bear market rally. Well, there's a few charts there that are interesting. Cash is at record highs, like by some margin. You can see on that chart there. Well, that's usually a sign of bullish leading indicator. The ASX 200 has now bounced 27% off its low. I reckon after 2.7% bounce, people were saying it's a bear market rally, don't worry. Well, that's a pretty big bear market rally. And indeed, with so much cash sloshing around, every percent that goes up sees those with cash hating the rally even more, railing against its lack of logic, blah, blah, blah. You know, we don't spend a lot of time analysing directional changes in markets because we think it's somewhat forlorn. We certainly don't take a cash position because we don't think that's a skill set that we necessarily have. But as an observation, the more people that scream at you as to the illogical nature of the just a bear market rally, the more convincing you become. And every time we've done the opposite in the crisis to date, we've been paid handsomely. And there is economic logic to doing the opposite, if you think about it. If everyone is keen to buy, then what does that do to the price? Clearly, it is prima facie higher. If everyone is keen to sell, what does that do to the price? Prima facie, it is lower. So it's therefore logical and economically sound to do the opposite. And the more people that tell you to do A, the more convinced you are to do B. And indeed, that's been the case here. I don't think people were anywhere near as bearish as they have been this crisis than they were at the very bottom. So we thought at the very bottom that the opportunities in a medium-term sense, we certainly didn't think of it in a short-term sense. The speed of the recovery has been way in excess of our expectation, but we were very excited about the opportunities in front of us and thought that some of the pricing was quite ridiculous. So do the opposite is a sound way to go, and maybe when all of these bears capitulate, spend their cash, one should indeed then go bearish and inverse yourself. So has this market run too hard? I don't know, but I can see lots of logic as to why the bounce has been so sharp. We'll start with the most obvious reason. This country has done a fantastic job, along with our friends across the ditch, at flattening the curve. If I was a bit of a smart aleck, I would have had some cartoon character there bludgeoning the curve, because that is effectively what has happened. And, you know, there's lots of speculation as to why. And you can see those two graphs there. The curve has indeed flattened incredibly impressively on the top left, and indeed in the bottom right, compared with two countries I just pulled out, Japan and the States, has seen a stunningly superior containment of COVID-19 deaths. So why? Well, we don't really know, do we? There is a sensational health system in this country that we are incredibly fortunate to have access to. There is a level of compliance here that is not witnessed in other jurisdictions. My brother runs two businesses in San Francisco, and it's effectively in lockdown and martial law. It is so much more aggressive in its application of the social isolation rules. It's not funny. It's a different world. It's not the collegiate approach that we're witnessing in this country. And I'm sure you've seen lots of footage around the world of less than compliant behaviour. I suppose being an island might help. Certainly the lack of density of population helps. Leadership has helped, and maybe summer has helped. To be honest, it doesn't really, outside of anecdotal curiosity, make a lot of difference as to why it just is. And as a result, if this crisis was born of fear as to the health consequences of COVID-19, it is entirely and simplistically logical that if we have indeed contained the virus more successfully than expected, that is a key positive. I'm making no claim as to how successful we will be here, second wave, return to normality, exposing us to further incidences, I have no idea. I'm just quoting the facts. It's significant in a health-led crisis that the health problem is being contained. Simple statement of fact, and it is undeniable that the success of that containment has been better than anyone anticipated. Other reasons, well, the stimulus is pretty big. That chart there shows you the fiscal stimulus as a percentage of GDP that's been announced in this country, and it is a clear second, just behind the States, who we saw on the previous slide has had a little bit more of a challenge in terms of containing the COVID-19's incidents in that country. So this is really large, especially when you find $60 billion under the bed. That was sort of an interesting little surprise for the federal government. That's a decade of all four banks, BHP and Rio's tax and royalty receipts, 60 billion. That's a seriously large number to find and now factor into the equation. I only laugh because it's so hard to believe. But this is large. This is without doubt able to, and I think what markets are doing is building a bridge. The biggest bearish argument I hear is that the economy is in tatters, the unemployment is through the roof, and the economic melee is unprecedentedly bad. That's true, but it only goes for a year, and you can build a bridge so that F21 is the only year that melee affects the broader economic community. Then it isn't as worrying as, 15 years of Great Depression only eased by the Second World War. That's a big difference. Whether it's that clean or not, I don't know. Whether we have indeed bounced past through that point of plausible trouble, I don't know. I'd probably say that the rally has, while you can hear me sort of take a little bit of delight in it hurting some of the very loud bears who got it so moralistic on everyone, it's probably pricing in now a recovery that is a little bit optimistic and requires things like this stimulus to be perfectly distributed. It's more likely to be a sawtooth recovery, and we're going to see lots of volatility ahead of us. But the stimulus is big. The stimulus is not to be ignored, and I think that it has already shown its buffering worth in the unemployment with JobSeeker, where folk who were at Star City and are now looking for employment can access that temporary relief. And it's a big number, with that 10.5% of GDP. That's way north of the GFC fiscal stimulus in this country. So what else can we say? Well, we can just say what was the case. It's 38% down. The market was simply pricing in too much negativity, we thought. And I won't labour the point. I'm sure you're very keen to get onto some stocks, and so am I. But the subsequent rally, given the success in flattening the curve, it doesn't really surprise. And that's not pretending that we predicted it. We didn't predict it. We did think that it was a great opportunity to buy into the medium term some oversold quality companies. We didn't expect some of those positions to pay off in 2 months. We thought it was more likely 2 years. But in hindsight, with the success of flattening the curve, it doesn't really surprise. And it's typical. It's probably got a bit of exuberance in it now and gone a little bit too far. The future sell-offs, they're almost inevitable. I do not think that the lows will be tested, though. I think you're going to go down to 55% now from here to achieve what you want in terms of unwinding the rally. Future sell-offs will occur. We're never confident about the short term and never are. Even in less volatile times, we find the short term to be somewhat of a random walk. In very volatile times, even more so. But the medium term is still to us very attractive when quality companies are being offered at such attractive prices, notwithstanding the bounce we've had. And as you'll see in a couple of slides' time, that we've changed the pecking order a little bit, and some of the candidates we had for high conviction positions have simply run through our target prices, and others have a long, long way to go. So I look forward to talking to that. The medium term I keep emphasising for the simple fact that crises end. We did talk about last time. I'll go through it at speed, but if we revisit the simple theory, what do they all have in common? Well, only one thing, and that's that they end. How long? We don't know. Isn't the right question. The right question is what's being priced. With a medium-term approach, one doesn't need to predict the impossible. One just needs to know that the crises end. Humanity finds a way to get itself in strife, but history shows humanity finds a way to also get itself out of strife, and therefore the opportunities available at the bottom are very compelling. So, enough of the generalities. Let's have a look at some specifics. So what are we doing at Solaris? Well, hopefully it's not a surprise, but we're doing the same in a crisis that has had a big recovery, as we were doing when the crisis was at its nadir. It's twofold. We are buying quality stocks that have been indiscriminately sold. We still see some opportunities in that regard, and we are avoiding and or shorting stocks that have weak balance sheets. You cannot find a way to victory in this market with a weak balance sheet. And we are somewhat flummoxed at the stubbornness of a few market participants who won't come to the equity table despite it being such a fluid and lucrative path for so many. I know dilution is on the cards, but the shareholder endorsement of so many of the equity raisings that we've seen, I would have thought, make it a pretty easy decision to convert some debt in this environment to equity. And those that have done that have been rewarded handsomely, because in this slide, if you like, you can go from the red left box in that process to the blue right box in one foul swoop. But the stubbornness, if you like, of some companies to change their capital structure sees them as fantastic negative candidates for us to keep picking on, if you like. And they will not get out of that negative loop until they address the blindingly obvious and the problem that is deafening over all others, and that's their balance sheet. So without a good balance sheet, you simply have one of two outcomes, as I may have mentioned in previous discussions. You will either not survive the crisis, most draconianly, if that's a word, or two, and more likely, you'll have a very deeply discounted rights issue at the wrong time or placement, such that new shareholders are the beneficiary of the post-COVID spoils, not current shareholders. So let's have a look at how some of our candidates, some of the stocks in the portfolio have fared and changed in terms of our views. I tried to restrict the universe of stocks here to stocks we talked about last time largely, and I've divided this page, which suddenly looks a little bit busy, into four. That's high conviction on the top left, stuff that we have owned, that we liked, that we think is now stocks approaching fair value in the bottom left. Top right, the defensive stocks, and then bottom right are the stocks that have run too hard, in our opinion. So let's start at the top left. The numbers there are a little bit stunning. That's the performance, absolute performance, in the 2 months since we last spoke of that group of stocks. I did not believe in my wildest dreams that the recovery for some of these would be so aggressive. I think what is easy to forget is just how brutally panicked the world was in the third week of March, including, I'm not saying we were panicked, but certainly we were scared. And adding to and buying these stocks, in hindsight, it sounds really easy. In reality, it was hard in mouth stuff, and the reaction from our stakeholders was very wide and very pointed in some regards. And we were accused more than once of being ignorant of risk, blithely putting clients' capital to the torch without enough respect for the crisis. And I take all that on except for the simple statement that if quality companies are trading at below their valuation, and sometimes materially below their valuation, we don't think too much more about the environment into which we would put capital their way, as long as they have a good balance sheet. We don't try and make that macro decision because we find that's a very spurious and difficult assessment to make, way more difficult than the stock assessment. So I suppose I don't have a lot of defense to that, except to say buying quality stocks at below fair value when they have good balance sheets in any environment is usually a winning trade, but usually over 2 to 3 years, not 2 to 3 months. Hardy's at 57 up, Star 86. I mean, these are frightening numbers. So Aristocrat, Macquarie, Atlas, and Hardy's are still 4 stocks that we see very large upside in. I'll just pick on Macquarie for a second. Had a stunning result a couple of weeks ago. When I say stunning, it beat market expectations by more than double digits, but for a provision that was put in that I could, if the kindest thing I could say about the provision was that it was very conservative. So if you stripped that out, the underlying was very strong. And I think the new CEO, Shamara, will prove to be one of the better CEOs this country has produced. I think she's very talented, ran the largest division under Nicholas Moore's reign for the better part of a decade to enormous success, and importantly now has a large kitty to play with after Macquarie raised money at $120 in August last year, very wisely. They love a crisis, Macquarie, without being blithe about some of the things that are going on, and are very good at exploiting and maximising opportunities in the volatility that a crisis brings. So we're particularly excited about Macquarie, and I get a 15% upgrade just by deploying half the surplus capital, assuming there's no diminution in returns, and I can see an argument where they would actually have an accretion of returns in deploying that capital. Hardy's, again, it was resilient last crisis. People mistake Hardy's for being too cyclical, borrow-like, and the IP that comes with its principal product is the reason it is far more resilient, far less cyclical, far less dependent on the economic conditions, and far more capable of producing its own earnings growth. Again, it was mispriced and mislabeled as overly cyclical, and again, it has proved to be very resilient. The 57% rally is one certainly not to scoff at, and indeed we've trimmed a little, but we still believe in the upside very strongly. And Aristocrat, we're seeing the land-based casinos open at a speed faster than was expected. We think it has a large amount of upside. The only knock on Aristocrat is how it's going at the very moment, when indeed those avenues to profit are stymied by the fact that the land-based casinos in the US are largely shut. Not a great time to be using a measuring stick, I wouldn't have thought. They'll come back online faster, it would appear, than expected. And importantly, I'd say Flight Centre is the same, Ramsay Healthcare to some degree. The competitive dynamic of Aristocrat's industry has improved markedly in their favour, with 2 or 3 of their competitors really struggling and maybe even unable to continue. And I suppose in a crisis, so much stuff is going on that you sometimes don't get the opportunity to do that industry structure analysis. And it's really important. Last man standing in a catastrophe is always the winner. The bottom left, we talk these stocks up mercilessly or very, very loudly. But Star Entertainment Group, not saying it's a disaster by any means, but at plus 86% from the middle to late March when we spoke last, that's taken it to fairish value for us on the basis of 2 things. So one, it actually isn't open yet. So that's a big change for a stock who doesn't have any revenue. The attraction for us was how much it had fallen despite having no revenue, because the revenue abatement would be for a short period of time. Having rallied 86%, that oversold situation is no longer. And up here, there's a lot of capex to be put in the ground for a very large project that, at least in part, was reliant on a lot of Asian gamblers coming down. The Brisbane is simply not big enough, as any Brizzo would attest, to support it themselves. Well, if they are capable of doing that, then that means Brisbane folk have lost a lot of money at the casino. So I hope that's not going to be the case. And Tabcorp, a little bit the same. It's just run further than we think the risks priced into the stock at this point. See it approaching fair value, so we have trimmed/exited those. The top right, I suppose the top right group is the most enigmatic of all this group and causes the most debate. They're very well-run stocks that have been sort of top of the pops for some time, not just the first downturn of the crisis, but last year plus 2 years. They have travelled very well. We just think they still look expensive for the growth in front of them. And, unless you have an Armageddon hat on and buy them by default because of your macro view, which isn't how we invest, we find it difficult, not as difficult, but difficult to invest. They have underperformed significantly. What I should have said overall on this page, sorry, this is against the backdrop of a 17% market increase over the period of time that I'm measuring this, which is the 25th of March to the 28th of May. I closed the business last night. And so at negative 4% average on those 3 defensives, we've seen circa 20% underperformance. And we were pretty scathing of Fisher & Paykel Healthcare last time. Again, not the stock operations, just the stock price. It had gone from 50 times pre-crisis to 65 times post-crisis, and it's come back away and isn't quite as off the chart as it was, and that pleases us, not to the degree that we would buy it, though. And all 3 of those still look expensive, still require some sort of scorched earth, in our view, macro environment to make them attractive. And then the last group, we've participated in quite a few capital raisings in the last 2 months. Interestingly, 2 of those were Flight Centre and Webjet, where we participated not in a balance sheet repair, but in a liquidity supplement, or putting cash on the table to pay the bills when there was no revenue. The most basic equity raising of all, the stay in business equity raising. And in both those cases, Flight Centre was unbelievable. It dropped 30% on its last day of trading, and then still had another 30% discount for the $7.20 raising. It was $45 3 weeks prior to that. But it doesn't have, it's got 5% of its revenues. Oh, that's not true. Sorry, 10% of its revenues with a little bit of fly in, fly out and pockets of bookings here and there. But that is a brutal scenario. And it really was a hard in the mouth, honestly, purchase. It's all but doubled up to $14. And so at that point, we think the fact that we still don't know when it's going to open, really, is the opposite. What was aggressively, the negatives being aggressively priced in at $7.20, such that you needed Flight Centre to be without revenue for a long, long time before that $7.20 wasn't attractive. Well, now it's the opposite. Now at $14, we're sort of worried that it's too optimistic as to how much, how early, how quickly the revenue recovery needs to be to justify Flight Centre's current valuation. Hence, we think that's run too hard. And Webjet is very similar. Don't forget that the raisings here were almost 1 for 1. So they now need twice the earnings to achieve the same EPS growth, number. And very similar to Flight Centre, they had to raise money for liquidity, not balance sheet repair, and they're a long way from revenue. And the stock is up even more as a percentage. $1.70 was the raising, and it was only a couple of months ago that the stock was north of $10. I think it peaked at 15. So these are massive falls. And indeed, Webjet has got up to $4 plus. So more than 100%, comfortably more than 100%. And like Flight Centre, the concept of when the revenue will return is not able to be predicted yet. So that's pricing in too much positive for us. And then finally, Scentre Group. The issue with Scentre Group, while we thought at 55% down that Scentre Group, despite not having any customers, not having any tenants that were open, we thought that that was way too low to sell. Scentre Group was trading at a fraction of book, I think 0.3 at the low, but it too has rallied aggressively. And the problem we have, which is not to their doing, is that we don't know what structural things the crisis will change in the commerce community. Lots of talk about office, properties not being as attractive, work from home. One thing, I don't know, I think it's too early to make those calls, to be frank, but I think one thing we can be somewhat sure of is that we have fast forwarded the internet adoption in a broader part of our daily lives, and retail shopping is at the top of that. And so while I'm no longer saying, I'm not switching and now saying that these shopping centres won't ever be filled again, they will, and it won't happen overnight, but the competition from online has stepped up a bit, such that Scentre Group's increase of more than 100% of its lows. Again, we think the risks are now in the favour of moving on and selling those shares, and that you're now perversely, very quickly, pricing too much positive there for three businesses, all very similar, where you don't have much revenue yet. So they're the three that we think that have run too hard. You could actually have quite a big collection there. There's been a lot, particularly small caps, that have run very, very hard. But that's the division of the four opportunities of landmines for us. I won't spend a lot of time on the next slide, but if I was to sort of attempt to justify, if you like, why, despite some pretty big increases in the likes of Macquarie, Aristocrat, Hardy's, why we still think they are conviction buys and conviction have a conviction place in our portfolios. These charts tell you, these charts are showing you not the share price change, but the change in the PE rel, so the relative PE to the market, how their PE compares to that of the overall index. And there's been some, still, despite the numbers that I was describing to you of the bounces, stark de-ratings of very quality companies. These are some of the better companies in our market: Macquarie, Aristocrat, Hardies, Horizon, and in all of those instances, there is a material de-rating of those stocks in the recent past, which gives us a lot of comfort that the risk of holding on to these stocks is quite modest. We believe there will be earnings upside to these stocks, but if there were not, the de-rating that has occurred acts as somewhat of a safety net. So that makes us pretty comfortable that indeed we aren't being too averse to the risks in front of us, and indeed we are pricing them appropriately. So if we keep going, what else are we doing? Well, now, and we've been very busy doing it over the last couple of months, there's a twofold attack that we've been through, but there's actually a third thing that we are now doing, which is indeed participating in balance sheet repair capital raisings. We've alluded to this before, but it's a very simple thesis, and that's that if debt is the biggest problem facing a company at a point in time, and the share price in a crisis is spiraling in the negative direction because of it, then replacing debt with equity and participating in an underwritten equity capital raising is in itself the positive. And it really couldn't be much simpler. You are self-fulfillingly participating in that which is solving, in part or in full, the problem. And the results have been quite stunning. If you go to the next slide, you'll see some very big numbers. These are numbers from the capital raising price to the current share price, and then the amount raised is in the graph at the top there. And I think the average, this might be a little bit of a dated comment, and I should have had a more up-to-date one, my apologies, but the average gain from raising price to current price of all of those stocks, and that's a complete list of stocks that have raised to date, the average gain, I think, is in the order of 25%, which is, if you had a look at the average gain of capital raisings in bull markets, they are usually for acquisitions, and they usually aren't a great use of capital. And the average gain would be materially south of the 25%. So perversely or ironically, the rule of thumb would be the worse the stock market conditions, the better the prospect of participating in ECM activity, which couldn't be more counterintuitive if you tried. But the busiest two periods our friends in investment banking land, ECM land, have had in the last 20 years have been the financial year ended 30 June 09 and what will be financial year ended 30 June 20. And we'll have to wait till the next crisis to get the third instalment of that. But we've got a snapshot there of some of the capital raisings that we've participated in. On the large caps, Lend-Lease, NAB, Ramsay Healthcare, QBE, all solid to spectacular. NAB's possibly worth dwelling on just for a second, is the only major that has got a massive benefit. The new straight-talking CEO was very compelling in how he described the need to be ahead of the pack in this regard. And I suppose it surprises us a little that the big four peers that haven't raised see it as such a important thing to not consider. I'm sure they're considering it. The facts are NAB went first. NAB has had a huge benefit from going first, and the flush/surplus capital position they are in now sees them, in our eyes, in a privileged position and a preferred position in terms of how we are attacking the banking sector. Lend-Lease, the same in a completely different sector, has a sometimes very volatile income stream, difficult to predict. Always good to have some capital buffer in that environment. And then on the small cap side, I mean, these are by no means the most successful of the small caps. Some of the performances of the small cap raises have been, you know, eye-watering. And what these numbers don't really tell you is how far down these stocks went before they raised. So they get into sort of this virtuous cycle of hell, in that everyone knows they have to raise, they sell the stocks, the small caps can be pushed around more than the large caps, and the spiral down gets worse and worse, and the discount that one needs to put on the raising gets greater as the debt value compared to the market cap gets worse and worse. And then the opportunity, and maybe a little bit opportunistically, and there's been a bit of press about this, for people like ourselves to participate at the fire sale price is extremely compelling. And there's a few examples there. We've talked about how we had long-term positions in our mind in Flight Centre and Webjet, just incapable of ignoring the stunning share price performance since we've been involved. And I can't really remember a period where there's hardly been a dud. I mean, we've participated in a fraction of the overall. You can see how many there have been overall. I'm sure there's one or two that could be extracted as failures, but it has been overwhelmingly positive. I think possibly the game has been played out. I think the best of the performance in participating in the capital raisings has been seen. Maybe, who knows? But I just say that because you know, the discounts are getting a little bit skinnier. The people coming to market now are those that resisted at lower share prices, so possibly more share price sensitive. And like most things, the quality is usually best earliest. So anyway, it's been a lot of it's been a really lucrative part of our world. We did talk to it last time, and we will continue to participate where appropriate. That is all I had for today. I hope you got something out of that. It wasn't meant to be anchored to last presentation. The only reason I did that so often is that purely through luck rather than management, we actually talked in this webinar last time, the third week of March, on the day of the low. And so it is such a stark difference talking to you today to where we were just 2 months ago. And so anchoring so many of the comments to that difference was too tempting to not do, and was how we think about it. It is really challenging when one is faced with Armageddon in almost the same breath. One is faced with unbridled enthusiasm. It requires a very clear mind, to be frank, bringing no judgment to the table and just seeing the price for what the price is, and believing that at the moment the stock market is a very poor provider of information. It is a fantastic tool to exploit, but not to gain information from. And I actually said exactly the same thing 2 months ago. Last time I was saying it in the negative, this time I'm saying it in the positive. The chart that you're seeing here amplifies all of that. It shows the percentage change from the prior day on a daily movement basis of the index. And, you know, with all due respect to, I don't mean to use a term without due respect, but the schizophrenic nature of this is stark. I don't know how one would ever relax in this sort of, what's the word, South Sydney world. There's a reversal going on here at lightning speed, such that as soon as one thinks that a direction has been found, the opposite occurs the next day. Volatility simply will be here to stay, is my conclusion. It's not particularly sage advice, but it is nonetheless a fact. We're not making big calls about where we're at. We probably think it's overboard a bit, but we don't share the manic bearishness of some of the wounded bears out there. We think that's pretty shallow analysis. We are taking a medium-term view, ignoring the information and the hysteria, and aware it will not be a smooth ride. At times, some of the portfolio pricing will see big variations, but the medium term to us is still very attractive. The intraday moves, prima facie, this is a good thing for active management, not a bad thing. Without volatility, we have no gig. And so we do and continue to embrace, enjoy, and believe that such a volatile world creates many opportunities. I really appreciate you taking the time to listen today. Hopefully you gained a little bit of an insight as to how we are attacking this world. And I'll pass back to Mark now, but look forward to answering any questions that might be forthcoming.
Sean, always great to get your views on the current state of play in the Australian equity market and how you're positioning portfolios going forward. I think your presentation really highlights and shows the benefits and skill set of active fund management. And as I mentioned at the start, the Solaris team are experienced hands in managing portfolios in both up and down markets. And the team, through their experience, have got a great ability to cut through the noise, assess the facts, and translate them into solid, consistent investment returns for your investors. Guys, online, just a reminder that all attendees do have the opportunity to ask questions via the screen. We have had a number come through, but I'll let people put some questions in. One thing I'd like to say before we do turn to questions, look, in addition to Solaris's highly successful long-short fund that the team manage, Solaris are one of the very few fund management groups who truly back their investment capability with their core performance alignment fund, which also which is part of the suite, and that has a 0 MER and only charges a performance fee when they outperform the index, and provides the core of what the Solaris long short team do in terms of their investment style and approach. And as I mentioned at the start, the team's track record really speaks for itself, and that they've outperformed the ASX in 16 out of 19 years. We have had a number of questions coming through the presentation, so I'll kick off with those, Sean. Parts of the market that have run ahead of itself, I know you covered that off. Are there any concerns considering the lack of information and earnings out there that worry you?
Thanks, Mark. There are. We touched on a couple. It's that area of the market that has had material increase in share prices, like the travel companies, that still don't have revenue and are still in large loss-making situations. And there'll come a point in the pretty near future where everyone will start calculating, how long did we do that liquidity exercise for? You know, how many months have they got sort of are they looked after for? And it's in no way a knock on companies. They are in the particularly unenviable position of having lost 85 to 95% of their revenue. And, you know, businesses in our era, maybe in any era, are simply not designed to handle such a scenario. So the stress, the impact on that group of stocks is very large. And I think Flight Centre, for example, are doing a fantastic job in an extremely difficult environment. But I'm sure the founders themselves would readily admit or concur that pulling out $1.9 billion of costs out of Flight Centre is a hugely difficult task, and is disruptive on a level that is going to have to be very carefully managed. So when those stocks go up more than 100%, we find them unable to be justified, and it's the exact opposite of what attracted us in the beginning. What attracted us in the beginning was, despite that list of negatives, the pricing was so low in share price terms that it was implausible that you'd be able to have an environment that justified the negativity. We're starting to get into the opposite, where it's somewhat odds on that the environment that's been priced into the stocks now is possibly too optimistic. Hence, we do worry about that group, and you can throw in the casino on top of that as well.
Yep.
I mean, there's a whole lot of other buckets, to be honest, of stocks that have run too far. We probably won't find out who they are until they declare their earnings downgrades.
Sean, you touched on NAB, and there's been a couple of questions here around the other banks. Would it have been prudent for Westpac and ANZ to raise capital like NAB to secure their capital ratios, or is deferring dividends a better strategy?
They're really hard questions. I just think that NAB's got an advantage, a quite significant one, by going first and taking the mantle. If I was a betting man, which I am, I'd say it's more likely than not that by the end of the crisis, 1, 2, maybe 3 of the remaining will have come to market. If you believe that, then NAB's got an advantage. Far from me to be lecturing Westpac, CBA or ANZ on the specifics of their capital management. I just make the unequivocal point that I think NAB has got an advantage. What would prove that wrong? A V-shaped recovery that saw us not have the economic dislocation that was feared. I suppose at that point you'd have to argue the opposite, that it was unnecessary. I think most investors believe, particularly with financial services, I mean, these businesses are geared 1,200 to 1,500% and 12 to 15 times. We participated in that raising because we enjoyed the comfort that was going to be sitting on the balance sheet as a buffer. And so time will tell, but I thought they got an advantage, no doubt. Deferring dividends, well, there's an APRA policy on that as well that extended to all financial companies, including the insurers. That's very challenging. The consequences of that are very challenging for some of the people who live off those streams of income. But it's not to be underestimated just how much of an increment to the balance sheets of these organisations that will have.
While we're talking banks, did you have a view on Macquarie? They reported since we did our last webinar.
Yeah, and it was a really important print. It was the first full year that was owned, if you like, by Shamara, the new CEO. And it's not that I'm being inappropriately personal, but I just struggled embarrassingly to appropriately pronounce Shamara's surname, as I've joked with her. And I think she is an exceptional CEO and executive. And but there's always a pause when a very successful CEO that she replaced, Nicholas Moore, hands over the baton, and everyone's looking to see if there's going to be a change, a negative change, particularly when that person has done very well. And far from it. It was a very impressive performance, both in the numbers that were delivered, the surplus that was retained, and the outlook that was enunciated. So, as I mentioned in the presentation, of particular interest to us is a very large surplus, so that sort of underlying double-digit growth that was delivered, notwithstanding challenging environments, and I'll talk to that in a sec, has included in it a big chunk of capital that isn't income earning that can be deployed. And so in my mind, that deployment underwrites future earnings growth, and Macquarie got the timing right again in their capital management by raising money at 120 in August. And there was lots of spook stories that went around with respect to, did they blow up in their airline business, leasing business? Macquarie sold half their airline leasing business within the last 12 months, and now only have the narrow body gauge planes that are more used for domestic rather than international, therefore less risky. There was a lot of consternation about Constellation, the gas trading business in the Gulf that has all but turned gas trading into a spot from a contract market. And we saw an oil price that had a double whammy of demand and supply crisis in that period that Macquarie reported on. And I don't know, what did the oil price fall? 70% over that period.
Yeah.
If ever there was going to be a test of Macquarie's statement that they don't take directional risk, they only try to exploit volatility, it would have been in that environment. And in fact, it had a great period, Constellation. So that very much proved the point. But there've been lots of rumours floating around that they've lost material amounts of money from the WTI volatility. So, you know, they're just snapshots. We absolutely back the management at Macquarie and the culture. They have a very strong culture of being entrepreneurial, dynamic, and willing to change appropriately, and that seems to have been absolutely retained under her watch. So yes, it's very much still at the high end of our conviction list.
Okay, sure. We're running out of time. One last question. We had a few people come in. Hadn't made many comments in the presentation on resources. Iron ore plays remain strong. What's your preferred allocation? How are you approaching resources?
The reason we haven't is that we're not very good at it. And we always find it the hardest part of the market to exploit successfully. And so when we're not very good at something, we admit it, and we try not to take a lot of risks there. We will give you the same boring, uninspirational answer every time that question is asked, and we make no apologies for it whatsoever. It's been the weakest sector in the 20 years of this team's union. Except for the last 4 years when we've taken that approach. And the revenue comes at you from a source that is highly unpredictable. I just mentioned the revenue from oil. I mean, oil was at what, 160 US within the last decade, and at one point this quarter it got down to mid-teens. So I mean, how does one run a business that has that volatility? I have no idea, especially when the CapEx timeline is the opposite, is so long and so hard to contain and see where the finish is. We find it very challenging. We don't take a lot of risk. We have a few rules that we've mentioned before. Stay in this country, except for the large diversifieds, be in the bottom quartile of the cost curve. Don't go to startups. And what have I forgotten? I can't believe I've forgotten the fourth rule. But the bottom line is that eliminates a large percentage of the resources universe. And for that, sorry, the fourth one is debt. Avoid companies that are over-geared in resources where the operational risk is more than enough. That eliminates most of your universe. And for that, we are in no way unhappy. That's good time management. Very hard to play small resource stocks. The answer to where we're positioned is, unsurprisingly, with that cautious view at the larger end of town, we find BHP, Rio, etc. have, and I'm just repeating myself, learned the lessons of the past with respect to how they allocate capital. Their capital allocation history is, quite frankly, atrocious, and had a big history of large acquisitions at the top of the cycle, large capital deployment at the top of the cycle, and they've changed this cycle. They have, in fact, given money back. They have done on-market buybacks, off-market buybacks, and are looking every bit like industrial companies, dare I say it, good industrial companies, ROEs going up. That's where we're mostly positioned. And we, in answer to or explaining the question as to why we're so quiet on resources, it is because we are unapologetically modest in the risk budget we allocate to resources, and we try to eke out a living in a low risk manner where we exploit a little bit of mispricing, and that's all we really try and do. And focus on winning where we think the inefficiency of markets are way more predictable. So yeah, that's the resources stance.
Fantastic, Sean. Look, we have run over time today and we will wrap up our Q&A. For anyone who we didn't get to your questions, we will certainly come back to you with respect to an answer for your question via the Pinnacle distribution team. Just on access, the Solaris funds are available on most platforms, and we are positively rated by all the major research houses with Lonsec, Zenith and Morningstar. We'll be making this webinar available on the Solaris Investment website later today, which is www.solariswealth.com.au. We certainly thank you for your participation today. We hope we've been able to provide you with some great guidance, especially during a great challenging period, through such a challenging period, and certainly appreciate your time today, Sean, in terms of taking everyone through the details of how Solaris is positioned. For any further inquiries, please don't hesitate to contact the Pinnacle distribution team. And we look forward to catching up with you in person or on our next webinar. Thank you very much and have a great day.